Good morning, everyone. Joe Mass here. It's May 9th, 2022, and I just want to give you a quick little update. The markets are continuing to adjust and correct for the fear of the Fed and all the geopolitical events. So I just want to give you a quick update, and then if you have any questions, just reach out to us. So as we've been communicating for quite some time, you've probably seen this slide here. It's our risk versus inflation slide. I've been doing this for 30 years. And this is probably the most difficult time emotionally that investors have ever had in my career. And that's because we're really at a crossroads, right? There's two sides of a coin. And when you flip a coin 100 times, it lands on heads or tails. It doesn't land on the side of the coin. And so we use this example to talk about risk on and risk off. So on the left-hand side, we have investors that are really worried about risk, right? They're concerned about all the geopolitical events out there, and they want to flock the cash. In fact, that's what the market's doing because most asset classes are down. Just about everything is down together, which is not normal. But if we go to cash or bonds or risk-off assets, because those are usually associated with lower returns, your negative return might be negative or your real return might be negative because inflation is so high. Now, we don't think inflation is going to stay high forever, but it's high right now. And so that is going to erode your cash. So on one side of the coin, we can use cash and bonds and risk-off assets, but expect lower returns. On the other side of the coin, we have investors that are worried about inflation. And so how do you fight inflation? Well, you fight inflation with equities and value stocks in particular and energy. If you want to go in bonds, you can have Treasury inflation-proof securities. Asset allocations working well right now to manage risk, commodities and alternative investments, and equity. But really, you have to take risk to fight that inflation. And so if you're on one side fighting inflation, that means you're taking risk, which is on the other side of the coin. If you're fighting risk, that means you're not fighting inflation. And that's harming you. So right now, it's really difficult to hedge your portfolio. Yet in a lot of our strategies, that's what we're trying to do. We're trying to find the side of the coin. But emotionally, it's going to be very difficult, and we're just going to have some patience right now because the market is definitely going through some turbulence with the Fed, with the invasion of Russia, with inflation, rates going up, all of the usual suspects in the headlines. So what do I do? Well, as an investor, what we want you to do is communicate. Please let us know if there's been any changes in your ability or willingness to take risk, okay? So in general, or more specifically actually, hold enough cash to make you comfortable, okay? Now, you can hold cash in and out of the portfolio. And what I mean by that is we're going to manage each portfolio per its mandate. So let me just pick on our focused growth strategy. Our focused growth strategy is an all-cap stock portfolio. It can go to small caps, it can go to mid-sized companies, large cap companies, it can go to international emerging market, it can go anywhere, okay? And it can also go to cash, which it's gone in and out of this year. Now, it's hard to go in and out of cash because the market has been whipsawed so much. And again, the market looks like it's oversold right now, and so it might rebound. But I'm going to hold a certain amount of cash in that portfolio. Maybe it's 50%, maybe it's 10, maybe it's 0, maybe it's 25, okay? But let's just pretend that that's the only portfolio you have for a moment, okay? And let's just pretend that I have 25% cash in that portfolio. If you would like us to increase your cash holdings outside of the portfolio, just let us know. You may say, Joe, I'd like to have another 10 or 15 or 20% cash on the sidelines right now, okay? That's fine. You just let us know, and we can make that adjustment regardless of how we're managing each portfolio. In our sailboat portfolios, we're shorting the bond market, which means when bonds go up, or we make money when rates go up. We're shorting the stock market, so we make money when the stocks go down. We're also long equities, meaning that we make money when equities go up, and we also have cash as well as being invested in some of the more favored sectors. So you can see that we're really working hard to find a way to hedge that portfolio, but we need to let that portfolio run and let us manage each portfolio per its mandate. So again, on top of our management style, which you don't have to worry about, we're automatically making those decisions for you. You can let us know if you'd like to increase or decrease any extra cash. Okay. The second thing that you can do is evaluate your investment policy statement and or update your financial plan. All right. A good financial plan is kind of like your parachute. You always want to have it in place before you need it. So in your investment policy statement, there's factors that we look at, like your ability and willingness to take risk. Okay, so you might want to update your risk profile. If you haven't done that in a while and you're worried, take a risk profile. We can get you one and update that, see where you fall. That's your willingness to take risk is usually your tummy test, right? And your ability to take risk is that required rate of return or how your financial plan comes together. So they need to be looked at together. Also, evaluate your investment time horizon. One of the biggest problems I've seen over 30 years is that, people ask us to build them, a long-term growth portfolio, a diversified portfolio or a focused portfolio, but they didn't ask us to build them a 10-day portfolio. So over any given period in the market, 10-day period, 2 weeks, a month, even a year, the market can go up and down. But if you want us to have a short-term portfolio, then we need to adjust it, okay? Now, I don't know what the market's going to do over the next 30 or 60 or 90 days, okay? There's evidence that it could go up. There's evidence that it could continue to fall. But we're pretty confident that based on interest rates, earnings, and inflation over the next 3 to 5 to 10 years, that equities are going to prevail. So when you're holding some world-class companies like we're holding in our portfolios, sometimes we have to be patient. We showed you some of the drawdown charts on our last communication that we put out last week or so. So again, some of these world-class companies, we just have to be patient. And it's kind of a broken record, but the FANG stocks, maybe minus Netflix, are still world-class companies that you want to own. The best ways to own great companies through stagflation, if that comes, or recession, if that comes, is to have good companies with good managers and people who know how to allocate their capital within those companies. So again, we're holding some world-class companies that have definitely had their trials and tribulations this year, but it doesn't mean that they're not good companies. And it's never a good idea to sell a stock just because the price goes up or down, okay? So again, we're going to adjust the portfolios automatically for you, and you don't have to worry about that. But we do have to deploy a little bit of patience because none of our portfolios are meant to be, 3-month portfolios. We do go to cash, we do short, so we're actively and tactically managing within those portfolios for you. But our investment horizon is still very important to evaluate, okay? Now, that comes to your liquidity needs. If there's any money that you need over the next 12 months, just let us know because that should be in cash. That shouldn't be subject to the market risks, okay? And if there's any annual distributions that you're planning for, just let us know so we can adjust the portfolios accordingly. Now, taxes are always something to look at. And so, if you're active in a taxable account, you might want to, evaluate a less active strategy in that account. But again, taxes are something you should always look at. Legal issues, if there's trust or anything going on, changes in your situation that we should know about, let us know about your legal concerns. And then anything unique to your circumstances that we should know about, okay, that may affect how we would want to allocate your portfolio. Just let us know. Okay, what do? Well, we don't overmanage every portfolio, right? Each portfolio, like I mentioned, has its own separate mandate. So it's like playing golf. So, we have a driver, we have a 7-iron, we have a putter, and we want to use the driver when we're on the tee. We want to use the 7-iron when it's mid-fairway. We want to use the putter when we're on the green. If I secretly turned your driver into a 7-iron, you wouldn't hit a very good tee shot, right? So every portfolio that we have is meant to be a very specific tool to help you meet your investment objectives. So we have like the sailboats that are tactical allocation. We have focused equity. We have individual bonds. We have everything that we need to build your portfolios, but we need to manage each one of them independently. So even though we go to cash in some portfolios, we don't go to cash in other portfolios because that's the way they're supposed to be run. Okay. So again, if you're in a portfolio that doesn't go to cash and you want to have some cash, like in the prior slide, just let us know and we can increase your cash holding outside of the portfolio that we're managing, okay? Now, we're always monitoring and adjusting as new data comes in, as interest rates change, as inflation changes, as corporate earning changes, as the Fed changes, as that mood of the market changes, we're trying to recalibrate the best as possible without over-managing, okay? And so through our whole process, what we're looking for reasonable risk-adjusted returns over reasonable time periods. And then we're going to try to communicate those changes to you as we manage your money, okay? Now, one thing that we want to remind you of, because this is a problem that I've seen over the last 30 years, Clients sometimes expect us to just change their risk temperament for them. Oh, well, just you do it. You do it. You guys know what you're doing. Just change it when you want to. And although we'll change the portfolios per the mandate, right? We'll manage the portfolios. What we can't do is change your risk temperament, your risk function. Okay. So as the slide says, we cannot proactively change your risk profile or risk tolerance, since these are personally unique to each of you. Okay. So you must communicate with us, and then we may adjust your investment strategy. So if there's been a material change in your willingness or ability to take risk or your situation, just let us know, and then we're happy to give you guidance on how to restructure the portfolio. And then of course we automatically manage that mandate or each portfolio mandate for you without you having to intervene. Okay, so I just wanted to give you a quick little update today. If you have any questions, give us a call. But these are some good things to remember to do when the going's looking rough and we're right in the middle of a rate change and inflation and all this geopolitical event. So hopefully this was helpful. We really thank you for letting us and trusting us to manage your money. We're going to take good care of you. Again, we're always striving to provide you with reasonable risk-adjusted returns. We're going to watch the markets. We're going to pay attention. And then, of course, we're going to communicate. So thank you so much. We really appreciate you. If you have any questions, just give us a call. Thank you so much.